Look at the two distinct realities playing out at this double bottom. On the left, retail traders place stop losses just below support, only to be knocked out of the trade as the market dips. On the right, institutions utilize that same depth to fill large-scale buy orders at that exact depth. Algorithms push the price past these obvious levels to generate liquidity. Once those retail stop losses are triggered, the price undergoes a sharp upward reversal as the institutional volume is filled. Predicting the exact moment of a reversal is a low-probability strategy. Instead, we react to the confirmed footprints left behind by these institutional algorithms. This line graph shows the specific four-step execution sequence. First, the price sweeps an internal low, the inducement. Second, it drops into an area of imbalance. Third, it taps the exact origin point of the institutional move. Finally, it reverses into the trend. High-level market structure only works when translated into a rigid mechanical checklist for entry execution. On this 4-hour candlestick chart, a clear double bottom has formed. This serves as internal inducement. Watch the next candle. Price aggressively pierces the line, stays momentarily, then pulls back, leaving a long downward wick. The algorithm pushes the price down to this depth because retail stop losses cluster there. Pushing past the bottom creates the liquidity necessary to fuel the expansion into the primary trend. A sudden spike past a structural low serves a mechanical purpose. It's an engineered event designed to generate the volume needed to move the market. To find the institutional footprints, we zoom in on the 3-candle sequence launching the reversal. Look at this explosive middle candle. Because the first candle's top wick and third candle's bottom wick don't overlap, they leave an empty pocket, a fair value gap. Market algorithms prioritize efficiency. They treat these empty spaces as gaps that need to be filled. Price will typically return to this zone to rebalance the market. Directly beneath that gap is the order block, the final down-close candle printed right before the aggressive capital injection. An order block is only valid if it meets 2 criteria. It must have caused a clean break of structure, and it must have an untouched fair value gap sitting immediately adjacent to it. Identify the valid order block among these clusters, A, B, and C. Apply the 2 rules covered. Cluster B is the correct choice. Cluster A failed to break structure, and C lacks an open fair value gap. Only B is a high probability origin point. Once price retraces and taps that 4-hour order block, we move to the 1-minute chart to identify our entry trigger. We wait for a micro change of character. Breaking this local high confirms the lower timeframe algorithm has aligned. Set your entry at that broken level. Place your stop loss below the 1-minute structure and target the next 4-hour high. This micro confirmation prevents entering a trade where price is still falling through your zone. It serves as a safety protocol to ensure the reversal is actually underway. Let's review the complete sequence. First, we map the macro structure and wait for the price to sweep the inducement. Price enters the imbalance and taps the origin block. We drop the time frame, trigger the micro chotch, and set the risk parameters to reach the profit target. Use this 6-step execution protocol for every trade. Map the macro structure, wait for the sweep, locate the POI, drop your time frame, confirm the shift, and set your risk. Trading is the practice of waiting for these specific institutional footprints. Wait for the trap, identify the imbalance, and execute at the origin point. Stick to the protocol, protect your capital, and follow the logic of the algorithm.
Modern financial markets operate at a scale completely invisible to human observation. Algorithms process millions of pricing decisions in milliseconds, executing complex structural maneuvers long before a trader can blink. Technical price action often creates patterns that appear mathematically perfect on a screen, yet these precise formations frequently precede the market's most violent and unexpected reversals. When a typical trader spots a pristine, multi-touch rising trendline or a perfectly aligned double top, they see an opportunity to enter the market. Traditional textbooks train participants to view these exact geometric formations as rigid zones of reliable support or impenetrable resistance. This split screen illustrates what is happening. On the left, the traditional view. However, algorithms engage in active liquidity engineering, deliberately building these pristine structures. On the right, geometric lines are irrelevant. Instead, they see glowing density heat maps, representing massive, highly concentrated pools of resting money. These zones are a dense clustering of retail stop-loss orders. Buy stops sit above the double top, sell stops underneath. With the trap set, the algorithm executes. The market aggressively pierces the resistance, triggering the cluster in a sudden burst before violently collapsing. For the breakout trader, this triggers an immediate, devastating loss. For the market maker, that loss is harvested as the necessary capital to fund a massive macro expansion. To stop trading on the wrong side of these moves, we need to deconstruct the exact sequence, from the initial liquidity creation to the deceptive algorithmic spike known as the Judas swing, down to the granular mitigation dynamics that follow. If you cannot identify the structural logic behind how liquidity is engineered, your own stop-loss will inevitably be used to fuel the institution's next position. The execution of this trap follows a strict mathematical cycle. It begins in a specific environment, the low-volume Asian trading session. This 1-hour chart of gold shows the Asian range, a sideways consolidation period. By oscillating back and forth, the market intentionally builds a flat line of equal highs at the top and equal lows at the bottom. During this phase, typical traders naturally place their protective stop-loss orders just outside the perceived safety of this consolidation box, trusting the established boundaries. This predictable behavior creates a dual-sided liquidity pool. The algorithmic market makers now have a dense, target-rich environment prepared for the upcoming session open. The algorithm uses this accumulation phase to compress a spring, setting rigid boundary targets before executing its true intent. Once the liquidity pools are full, market makers deploy a specific algorithmic maneuver at major volatility injection points, specifically the London or New York session opens. This maneuver is called the Judas swing. It is a sudden, aggressive vertical impulse wave that completely shatters the top of the Asian range. The immediate retail reaction is highly predictable. Momentum traders instantly rush into long positions, convinced that a legitimate, high-volume breakout trend has just begun. Simultaneously, early short sellers are liquidated as buy stops are violently triggered by the spike. But this move has a hidden target, a higher time frame point of origin just above the retail noise, a premium 4-hour bearish order block. Market makers use the violent upward breakout as engineered bait, designed to trap buyers at the absolute maximum price point before the trap snaps shut. Executing the Judas swing requires a massive injection of capital. Moving the market this aggressively infers a significant, hidden operational cost for the market maker. On this split screen, the bottom ledger shows the algorithm executing massive buy orders, forcing price up through retail resistance. Instantly, the market maker floods the book with shorts, plunging the price, turning those initial forced buy positions bright red. This creates a mechanical paradox. While the institution is successfully driving the market down to profit on their massive short positions, the initial buy orders used to create the Judas swing are now trapped deep underwater in negative drawdown.
Market makers operating at a multi-billion-dollar scale cannot leave massive algorithmic drawdowns unresolved on their ledgers. To balance the books, the algorithm requires a temporary suspension of the new macro downtrend. The algorithm will artificially pull the market back up toward the exact origin point of the initial trap. This operational deficit creates a mathematical certainty. Price is mechanically forced to return to the trap's origin to clean up the ledger, initiating what is known as the mitigation phase. The mitigation run is this highly calculated upward retracement directly back into the order block that caused the initial drop. The purpose of this run is strictly accounting. It allows the institutional algorithm to close out those underwater buy positions at exactly zero loss, while simultaneously layering in a fresh wave of short positions. However, the depth of this retracement dictates future price action. Not all mitigations clear the entire institutional ledger at once. Look closely at this 4-hour order block. When the price line retraces upward and lightly taps only the very bottom edge, the open or the wick of the block, it performs a partial mitigation. Since price only touched the periphery, a cluster of orders sits untouched deeper within. Conversely, full mitigation happens when price pushes deeper, striking the dotted center line, splitting the zone exactly in half, the 50% mean threshold. Striking this mean threshold represents a total clearance of the ledger. It completely drains the zone of any remaining institutional orders,
rendering that block exhausted. The mitigation run functions as a mathematically dictated rebalancing act, clearing institutional risk before the true macro downtrend can safely expand. Now that we understand the internal mechanics of the institutional trap, we can systematically exploit it for precise market entries. The absolute foundational rule for advanced execution is simple. You must never trade the initial breakout of equal highs or equal lows. The only viable entry vector is the secondary reversal. You must wait for the breakout to fail and the mitigation to complete. This chart shows the Judah swing on the 1-hour time frame, but to enter safely, we zoom directly into a 1-minute view of that exact collision point. On this micro time frame, price action must prove the trap is over. Candle bodies cleanly reject highs, aggressively close downward, breaking local structure to print a micro change of character. This specific microstructural shift signals that the trap has snapped shut, and the institutions are now initiating their true directional intent. To execute this consistently, follow a strict operational protocol. Step 1. Locate engineered retail patterns like clean double tops or perfect trend lines on your 1-hour chart, and explicitly label them as liquidity targets. Step 2. Exercise strict patience for the Asian accumulation phase. Anticipate a violent stop hunt precisely at the London or New York session open. Step 3. Verify that this violent upward sweep makes direct contact with an unmitigated order block sitting just behind the retail illusion. Step 4. Drop to the 1-minute chart. As shown here, the entry executes on the micro pullback following the structural shift. Your risk parameters are now protected by institutional structure. The protective stop loss must sit safely beyond the absolute highest extreme of the engineered Judah swing wick. With your entry secure, your final profit objective is mathematically defined. Target the inverse liquidity pool that the algorithm engineered on the exact opposite side of the macro range. The difference between retail participation and algorithmic execution is predatory objectivity. A retail trader searches a chart for a familiar geometric pattern to dictate where they should enter the market. An institutional trader scans the exact same chart solely to locate where the highest density of retail stop losses is currently trapped. Once you stop reacting to textbook illusions and wait for the algorithms to hunt the engineered liquidity, you cease being the victim of the market and begin trading alongside its true architects.